Cash is the oxygen your business needs, helping you not only to exist, but grow as well. But understanding the movement of your cash can often be a tricky process, especially if you're a new business owner. Welcome back to Ask My Accountant. I'm Laura, your trusted accounting nerd at Sleek, a one-stop digital platform to manage all your business needs from accounting, taxes to government compliance. By the end of this video, you'll have a greater understanding of what the statement of cash flows is and hopefully be loving the benefits it can provide to your business. So are you ready? Let's go. Let's get right into it. The statement of cash flows. What is it? Put simply, the statement of cash flows tells you how much cash you've spent and earned in a period, and the key drivers. So why do you need to love it? It gives you a really useful insight into where your precious cash has been used and sourced from. If you're burning through your cash faster than you anticipated, then reviewing your statement of cash flows will help you identify where you've overspent so that you can change tactics in the future. This statement accompanies the statement of profit and loss and the balance sheet as one of the three key financial statements that, together, give you an excellent insight into your business's financial position and profitability. So, what does it look like? For this episode, I'm going to use the example of an ice cream retailer to help us visualize and understand the statement of cash flows. So here it is. And from what we can see, the business has had a positive net cash flow of $30,000 for the year ending 31 December 2020. Now, let's walk through the key items so it's clear where this cash has come from. Firstly, let's take a look at the structure. The statement of cash flows identifies separate cash flows coming from, firstly, operating activities. This is cash coming from the main course of business. For example, selling ice cream, paying staff wages, and paying rent for the premises. Secondly, investment activities. This is cash coming from investing in new assets for the business, or investing excess cash in shares, for example. Thirdly, financing activities. This is cash coming from sources of finance, most likely in the form of a loan from the bank or an equity injection from shareholders. It can also include dividends paid to shareholders. Secondly, let's walk through the key line items in their statement of cash flows. Net income. Simply put, this is their profit, and you will be able to agree this to the statement of profit and loss. Now we know that profit doesn't always equal to cash, so the statement of cash flows is structured as a series of steps that gradually adjust our profit or loss to equal the cash inflow or outflow we've seen in that period. This also gives great insight into where that cash has come from and gone to. So let me explain. Step 1, adjustments for non-cash items. A prime example of a non-cash item is depreciation. This is the process by which the value of an asset held on the balance sheet, for example a car, is reduced over the years to reflect the fact that you wouldn't be able to still sell it for the same price at which you bought it. A depreciation charge is included in profit, but no actual cash changes hands in this process, so it needs to be added back to the profit. Step 2, changes in operating assets and liabilities. In this step, we look at the balance sheet to identify if we have any outstanding receipts from customers or expected payments to suppliers. This would mean that some revenues and expenses in our profit figure haven't been settled in cash yet, so we would need to add them back. An example of this is a supplier providing the ice cream store 7 days to pay for a shipment of ice cream received. The expense has been incurred because they have the goods, but the cash hasn't left the business yet. This is the impact of accrual accounting, which we'll cover in the next video. Step 3, sale and purchase of fixed assets. When we invest in fixed assets to support the running of our business, we do not record this as an expense in our profit and loss. Instead, it is recognized in the balance sheet as an asset or an item we own. This means that the cash impact of buying the asset hasn't been captured in profit, and we would have to add it back in this step. In this case, the ice cream store has decided to purchase a new ice cream van for $20,000 so that they can boost their sales by accessing more locations. Step 4. Proceeds from long-term loans. This refers to proceeds from sources of finance. In this case, it would be from the bank, who provided a loan of $20,000 so that the ice cream business could buy their van. This loan sits in the balance sheet again and not in the profit, so we need to add it back to the profit in this step. In reality, there are a whole lot of steps that you might take to align your profit with your cash, but for starters, these are the key ones. And there you have it. That was a quick rundown of the essential components of the statement of cash flows and the key things to take note of. Hopefully you now have a better understanding of why this financial statement is useful and why so many business owners love it. If you liked this episode, subscribe, give this video a thumbs up, and don't forget to leave any questions in the comments section below. Till next time, I'm Laura from Sleek, and I'll see you in our next episode. Bye!